Welcome. Have you ever wondered how successful investors choose the right stocks and grow their wealth? Today, we'll explore Common Stocks and Uncommon Profits by Philip Fisher. This book is a must read for anyone looking to invest wisely. Fisher's strategies focus on deep research, long term thinking, and finding high quality companies. If you want to make better investment decisions, stay with us as we break it down in simple terms. Let's get started. Research before you invest. The Scuttlebutt Method. Philip Fisher believed that successful investing starts with thorough research. He introduced the Scuttlebutt Method, which means gathering information from people who know the company well. This includes employees, customers, suppliers, and even competitors. For example, if you're thinking about investing in a tech company, don't just look at its stock price. Find out what customers say about its products, how employees feel about the management, and what experts think about its future. If the company has a strong reputation, it could be a great investment. But if you hear many negative reviews, think twice before investing. To give a modern example, think about Tesla. Before investing, you might talk to Tesla car owners, research the company's battery technology, and check how its competitors like Ford or General Motors are responding. This kind of research gives you an edge over casual investors who rely only on stock charts. What makes a great company? The 15-point checklist. Fisher created a 15-point checklist to help investors identify great companies. Here are some of the most important factors. 1. Growth potential. Does the company have a bright future? A good investment should continue to grow over time. 2. Strong leadership. Great companies have smart and ethical leaders who make wise decisions. 3. Innovation. Companies that invest in research and development stay competitive. 4. Profit margins. A financially strong company should have good profits and manage its costs well. 5. Market expansion. Can a company grow into new areas or markets? If a company checks most of these boxes, it might be a strong investment choice. To apply this in the real world, let's consider Apple. It has strong leadership, continuous innovation with products like the iPhone and MacBook, and a huge global market. That's why its stock has performed well over decades. The power of long-term investing. Many investors focus on short-term gains, but Fisher believed in long-term investing. His advice was simple. Find great businesses and hold on to them for years. For example, people who invested in companies like Apple or Amazon early on and held onto their shares saw massive returns. The mistake many investors make is selling too soon out of fear. But if a company is still growing and performing well, Fisher recommends staying invested. The stock market goes up and down, but strong businesses keep growing over time. Let's take another example. Imagine you invested in Google, Alphabet, back in 2004. Many investors might have sold after a 50% increase, but those who held onto their stocks have seen returns of over 2,000% today. The role of strong leadership. A company's leadership is one of the most important factors in its success. Fisher emphasized the need for capable and ethical management that focuses on long-term growth. How can you judge a company's leadership? Look at their track record. Do they make smart decisions? Are they honest with investors? Do they focus on innovation and customer satisfaction? If a company has weak or dishonest leaders, it's best to stay away. For instance, Warren Buffett famously avoids companies with questionable leadership. He believes that even a great business can fail if the wrong people are in charge. That's why he invests in companies with strong leadership, like Coca-Cola and Berkshire Hathaway. Ignore short-term stock price fluctuations. Stock prices move up and down every day. Many investors panic when prices drop, but Fisher believed this was a mistake. Instead of worrying about short-term movements, focus on the company itself. Ask yourself, is the company still growing? Are its products still in demand? Is the management strong? If the answer is yes, don't let short-term market changes scare you. Successful investors focus on the business, not just the stock price. During the 2008 financial crisis, Amazon stock dropped significantly. Many people sold out of fear, but those who understood Amazon's business model and leadership held on. Today, Amazon is one of the most valuable companies in the world. Common mistakes investors should avoid. To be a successful investor, avoid these common mistakes. 1. Ignoring research. Many people invest without truly understanding a company. Always do your homework before investing. 2. Investing in bad leadership. A company with weak leadership will struggle to succeed. 3. Selling too soon. Many investors sell stocks too early out of fear. If a company is still strong, hold on to it. 4. Chasing hot stocks. Just because a stock is popular doesn't mean it's a good investment. Focus on companies with real long-term potential. By avoiding these mistakes, you can make smarter investment choices and build a strong portfolio. Another mistake is following stock tips blindly. Imagine hearing that a new social media company is the next Facebook. If you invest without research, you might end up losing money. Always verify information before acting on it. Applying Fisher's principles in today's market. The stock market has changed since Fisher's time, but his principles still apply. Today, investors have access to more information than ever, including financial reports, analyst ratings, and online forums. However, this doesn't mean you should rely on just numbers. Fisher's scuttlebutt method is even more valuable now. Before investing in a company, read customer reviews, watch interviews with CEOs, and study industry trends. The goal is to gather as much information as possible before making a decision. For example, if you're considering investing in a renewable energy company, you might check how governments are supporting green energy, what customers say about their products, and how competitors like Tesla are performing in the same space. In Common Stocks and Uncommon Profits, Philip Fisher teaches us that great investing is about careful research, long-term thinking, and focusing on strong companies. His approach helps investors build wealth by making smart, informed decisions. If you want to become a better investor, start applying these principles today. Look beyond stock prices, research companies deeply, and stay patient. Your future self will thank you for it. Thanks for listening. Stay tuned for more insights on smart investing. Happy investing.